should you buy VXF? Unveiling the Vanguard Extended Market ETF. Hey everyone, welcome back to Chat ETF. Today we're diving deep into the Vanguard Extended Market ETF, also known as VXF. You might be wondering, should you add this ETF to your portfolio? VXF tracks the small and mid-cap market segment, offering potentially explosive growth, but also some bumps along the road. We'll break down the nitty-gritty, the fees, the diversification benefits, and the potential risks. By the end of this video, you'll be a VXF expert, ready to decide if it's the right fit for your investment goals. So stick around, grab your favorite coffee, and let's chat ETFs. Question 1. What is Vanguard Extended Market ETF? The Vanguard Extended Market ETF, ticker symbol VXF, is an exchange-traded fund, ETF, designed to track the performance of small and mid-capitalization stocks in the U.S. market. Here's a breakdown of what that means. Target market. Small and mid-cap stocks. VXF focuses on companies with a smaller market capitalization compared to large, well-established corporations. These companies are generally younger and have higher growth potential, but also carry more risk. Investment strategy. Passive management. VXF is passively managed, which means it tracks a specific index. In this case, the index likely measures the performance of a basket of U.S. small and mid-cap stocks. The ETF doesn't try to outperform the market by picking individual stocks, but rather aims to mirror the index's performance. Index sampling. VXF might utilize index sampling to track the benchmark index. This means it might not hold every single stock in the index, but rather a statistically representative sample. This helps reduce costs associated with buying and holding a large number of securities. Question 2. What is the Vanguard Extended Market ETF's primary investment objective? The Vanguard Extended Market ETF, VXF, has one primary investment objective: to track the performance of a benchmark index that measures the investment return of small and mid-capitalization stocks in the United States. Here's a deeper dive into what this means. Focus on small and mid-cap stocks. VXF isn't interested in the biggest players on the market. It specifically targets companies with a smaller market capitalization. These are generally younger, growing companies that haven't reached the size of industry giants. Matching the benchmark index. VXF doesn't try to actively pick stocks and outperform the market. Instead, it aims to mirror the performance of a specific index. This index likely includes a basket of U.S. small and mid-cap stocks. By following the index, VXF's performance should closely resemble the overall performance of that group of stocks. Why track an index? There are a few reasons why VXF chooses a passive approach of tracking an index. Diversification. By following an index that holds a variety of small and mid-cap stocks, VXF offers investors exposure to a broad segment of the market in one shot. This helps diversify a portfolio and reduces risk associated with being overly invested in a single company. Lower costs. Passively managed funds like VXF tend to have lower expense ratios compared to actively managed funds. This is because they don't require a team of analysts constantly researching and picking stocks. Lower expenses mean more of your investment goes towards potential returns. Question 3. Does the Vanguard Extended Market ETF track a specific index? Yes, the Vanguard Extended Market ETF, VXF, most likely tracks a specific index. While Vanguard doesn't explicitly state the exact index on their website, there's strong evidence to support this claim. Here's why. Passive management. VXF is a passively managed ETF. Passively managed funds don't attempt to outperform the market by picking individual stocks. Instead, they aim to replicate the performance of a specific market index. Benchmark referencing. The description of VXF mentions it seeks to track the performance of a benchmark index that measures the investment return of small-cap and mid-cap stocks. This benchmark index serves as the blueprint that VXF tries to follow. Possible benchmark index. Unfortunately, Vanguard doesn't publicly disclose the specific index VXF tracks. However, based on the fund's objective, a strong possibility is the SP Completion Index. This index includes all U.S.-listed stocks excluding those already in the SP 500 index. This aligns with VXF's target market of small and mid-cap stocks. Other possibilities. There's a chance VXF tracks a proprietary index developed by Vanguard that serves a similar purpose as the SP Completion Index. However, due to the lack of public information, it's difficult to say for certain. Understanding the importance of the index. Regardless of the specific index, understanding this concept is crucial. Performance dependence. The index VXF tracks heavily influences the ETF's performance. If the index goes up, VXF's price should generally go up as well, and vice versa. Transparency and risk assessment. Knowing the underlying index allows for further research. You can analyze the index's historical performance, composition, types of companies included, and volatility to assess the potential risks and rewards associated with investing in VXF. Question 4. What is the underlying asset class of the Vanguard Extended Market ETF? The underlying asset class of the Vanguard Extended Market ETF, VXF, is equity, specifically focused on small and mid-capitalization stocks. Here's a breakdown. Equity asset class. VXF invests in companies, which makes it an equity fund. Equity ownership represents a share of ownership in a business, and the value of the ETF is tied to the performance of the underlying companies. Market capitalization focus. However, VXF doesn't invest in just any company. It specifically targets stocks of companies with a smaller market capitalization. Market capitalization refers to the total market value of a company's outstanding shares. Small cap and mid cap breakdown. Small cap stocks. These are generally younger companies with a market capitalization ranging from $300 million to $2 billion. They offer potentially higher growth prospects, but also carry greater risk due to their smaller size and limited track record. Mid cap stocks. These companies are typically more established than small-cap companies, with a market capitalization ranging from $2 billion to $10 billion. They offer a balance between potential growth and stability compared to small-cap stocks. Why focus on small and mid-cap? There are a few reasons why VXF chooses this segment of the market. Growth potential. Small and mid-cap companies often have the potential for high growth as they establish themselves in their respective industries. Diversification. By focusing on this market segment, VXF offers exposure to a different set of companies compared to large-cap focused funds. This can help diversify a portfolio and reduce overall risk. Question 5. Does the Vanguard Extended Market ETF employ any quantitative investment strategies? The Vanguard Extended Market ETF, VXF, likely utilizes some elements of quantitative investment strategies, but not in the way you might expect. Here's a breakdown. Quantitative strategies, defined. Quantitative investment strategies rely on mathematical models and statistical analysis to make investment decisions. These models consider various factors like historical price data, company financials, and market trends to identify undervalued or promising investment opportunities. VXF's indexing approach. While VXF doesn't actively pick stocks based on its own quantitative models, it might utilize some quantitative elements behind the scenes. Index selection. The decision to track a specific index, like the SP Completion Index, assumed benchmark, might involve quantitative analysis. The index provider likely uses models to select and weight the various small and mid-cap stocks within the index. Index sampling. Possible VXF might employ a form of quantitative sampling to track the benchmark index. This means statistically selecting a representative subset of the index holdings instead of buying every single stock. This can be achieved using optimization techniques to minimize tracking error, difference in performance between VXF and the index. Limited role of quantitative strategies in VXF. However, it's important to understand that VXF itself doesn't actively use complex quantitative models to pick and choose individual stocks within the ETF. Passive management. VXF is a passively managed ETF. This means it tracks a predetermined index and doesn't attempt to outperform the market through security selection. Focus on low cost and tracking error. The primary objective of VXF is to provide low-cost exposure to the small and mid-cap market segment by mirroring the performance of the benchmark index. The quantitative aspects likely focus on efficiently replicating the index and keeping tracking error minimal. Question 6. Does the Vanguard Extended Market ETF use any leverage or derivatives? No, the Vanguard Extended Market ETF, VXF, does not typically use leverage or derivatives to achieve its investment objective. Here's why. Passive management strategy. VXF is a passively managed ETF. This means it tracks a specific index and aims to replicate its performance. Passively managed funds generally avoid leverage and derivatives due to their complexity and potential risks. Focus on underlying assets. VXF seeks to provide exposure to the returns of small and mid-cap stocks. Leverage and derivatives can introduce additional layers of risk and potentially magnify losses. By directly investing in these underlying equities, VXF offers a more transparent and predictable way to participate in this market segment. Understanding leverage and derivatives. Leverage involves borrowing money to amplify potential returns. In the context of ETFs, it's rarely used, as it can significantly increase volatility and magnify losses. Derivatives are financial contracts whose value is derived from an underlying asset, like a stock or benchmark. Options and futures are common examples. Passively managed ETFs typically avoid these instruments due to their complexity and the potential for unintended consequences. Transparency and cost efficiency. By avoiding leverage and derivatives, VXF offers several benefits. Transparency. The ETF's performance is directly tied to the underlying holdings, small and mid-cap stocks. Investors can understand the drivers of returns without the added complexity of leverage or derivatives. Cost efficiency. Leverage and derivatives can introduce additional fees and expenses. VXF's focus on directly holding equities helps keep the expense ratio low, which translates to more of your investment going towards potential returns. Question 7. How has the Vanguard Extended Market ETF performed in different market conditions? The Vanguard Extended Market ETF, VXF, generally exhibits more volatile performance compared to the overall stock market, particularly during different market conditions. Here's a breakdown. Reason for volatility. Small and mid-cap focus. VXF invests in small and mid-cap stocks. These companies are inherently more volatile than large-cap companies that dominate the overall market. Their stock prices tend to fluctuate more significantly in response to various economic factors and company-specific news. Performance across market conditions. Bull markets. During bull markets, where stock prices are generally rising, VXF has the potential to outperform the broader market. The growth potential of small and mid-cap stocks can be amplified in these periods, leading to potentially higher returns for VXF. Bear markets. Conversely, bear markets characterized by declining stock prices can be challenging for VXF. The underlying holdings, being more volatile, can experience steeper price drops compared to the overall market. Economic sensitivity. Small and mid-cap companies are often more sensitive to economic conditions compared to larger, more established corporations. During economic downturns, these companies might be more susceptible to reduced consumer spending or tighter access to credit, leading to potentially larger performance declines for VXF. Question 8. What are the key risks associated with the Vanguard Extended Market ETF's investment strategy? The Vanguard Extended Market ETF, VXF, offers exposure to small and mid-cap stocks, but this investment strategy comes with several key risks to consider. 1. Higher volatility. Compared to large-cap stocks that dominate the overall market, small and mid-cap companies are inherently more volatile. Their stock prices tend to fluctuate more significantly in response to various factors. Market swings. During bear markets, VXF can experience steeper price declines compared to the broader market due to the underlying holdings sensitivity. Company-specific news. Positive or negative news about a company in the ETF can have a more pronounced impact on its stock price compared to a large-cap company. Economic sensitivity. Small and mid-cap companies are often more reliant on economic conditions than larger corporations. Downturns can lead to reduced consumer spending or tighter credit access, impacting these companies and potentially causing larger performance declines for VXF. 2. Limited diversification. While VXF offers exposure to a basket of small and mid-cap stocks, it's still less diversified than a total stock market index fund. This concentration in a specific market segment can magnify potential losses if that segment experiences a downturn. 3. Growth potential uncertainty. While small and mid-cap stocks offer the potential for high growth, this growth isn't guaranteed. Many young companies fail to achieve their full potential, and their stock prices can suffer. 4. Passive management risk. VXF tracks a benchmark index. There's no guarantee the chosen index will outperform the market, and the ETF's performance is inherently tied to the index's composition and weighting. 5. Liquidity risk. Small and mid-cap stocks can be less liquid than large-cap stocks. This means it might be easier to buy and sell large quantities of shares in large-cap companies, compared to VXF's holdings. Less liquidity can lead to wider bid-ask spreads, the difference between the price a buyer is willing to pay and the price a seller is willing to accept, and potentially make it more difficult to enter or exit positions quickly.